Hey everybody, welcome back to the channel. I'm your host, and today we're unpacking everything that went down last week from June 8th to June 14th in 2025 in the world of finance, the economy, markets, and trading. It was a week packed with big moves from a game changing trade deal to fresh economic data that's got everybody talking. Whether you're an investor, a trader, or just someone trying to figure out what's happening with your money, I've got you covered. So grab your coffee or tea, no judgment here, and let's get into the action. Now, before we get into the details, here's a quick rundown. The US and China shook hands on a trade framework. Economic numbers gave us some clues about what's next, and markets had their share of ups and downs. We're going to break it all down, look at what it means for you, and even peek ahead about what might be coming. Ready? Let's go. All right, let's start with the headline that dominated last week. The US and China finally agreed on a trade framework. I know. If you've been following the saga, you might be thinking, is it real this time? And honestly, I get it. Like, trade tensions between these two economic giants have been dragging on for years, sending markets into a frenzy every time a new tariff threat popped up. But last week, negotiators met in London and came out with something concrete, or at least concrete ish. So, what's in this deal? Here's the scoop. The US is slashing tariffs on China exports from a hefty 145% down to 55%. That's a big drop, though 55% isn't no picnic. In exchange, China stepping up to supply critical magnets and rare earths. Those are the materials that power everything from Tesla batteries to your iPhone. There's also talk about loosening up tech export controls and letting Chinese students study at US colleges again. It's a broad framework and it's got implications for industries across the board. Check this out. Those tariff cuts are a huge signal. For context, tariffs that high were choking trade flows, jacking up costs for companies and trickling down to the consumer. Think about it. Higher tariff prices means pricier goods at the store, so bringing them down to 55% could ease some of that pressure. But, and this is the key, it's not a full resolution yet. This is a framework, not a signed and sealed contract. So both sides are still going to need their leaders to sign off, and we've seen deals fall apart before. Now, let's talk about why this matters beyond the headlines. Trade tensions have been a dark cloud over the markets for a while. Every time the US and China rattled the saber, stocks would dip, investors would panic, and we'd all brace for the worst. This framework feels like a ray of sunshine breaking through, at least for now. It's a sign that both sides might be ready to de-escalate, which could stabilize the global supply chains and boost confidence. In the markets, oh, they noticed. The day this news hit, June 10th, the S&P 500 rallied over 1%. That's not a small move. The Dow and Nasdaq jumped too, though tech stocks really stole the show, and we'll get into that later. Now, investors were relieved to see some of the progress. After all, trade uncertainty has been like a weight on their shoulders, and this felt like someone finally lifting a little. But here's where I pump the brakes a bit. Yeah, that's exciting, and it's not time to celebrate just yet. The framework is just a starting point, not a finish line. There's still a chance this could unravel if negotiations stall or if geopolitical tensions flare up elsewhere. I mean, look at the Middle East. We'll talk about that later, but stuff like that could throw a wrench into everything. So, my take, it's a positive step, but keep your eyes peeled. Now, let's zoom in on who's affected. Tech companies, for one, are breathing a sigh of relief. Those rare earths from China, they're critical for semiconductors and batteries. Companies like Apple, Tesla, Nvidia could all see their supply chains getting a little smoother. Agriculture is another winner. Lower tariffs might mean more US soybeans or pork heading to China. But on the flip side, industries like steel or manufacturing that leaned into those high tariffs for protection might feel the squeeze. I've got a buddy that works in logistics. He was telling me about how these tariffs have been a nightmare for shipping costs. He's hopeful the deal sticks because it would mean fewer headaches or maybe even lower prices for all of us. But being honest, he's also skeptical because we've been burned before. So what do you guys think? Optimistic or cautious? Let me know in the comments. All right, shifting gears, let's talk about the economy. Last week gave us some fresh data to chew on and is painting a picture of where things stand. First up, inflation. The consumer price index, or CPI, for May came in at 2.4% year over year. That's basically how much prices have gone up compared to last year, and it was right in line with what analysts expected. See this? The 2.4% inflation is pretty tame. To put it into perspective, imagine your normal coffee. If it cost $5 last year, a 2.4% increase means it's now 5.12. Not a big jump, right? For the Federal Reserve, this is pretty good news. They've been aiming at 2% inflation, and now 2.4% is close enough that they're not freaking out. Why does that matter? Because inflation dictates what the Fed does with interest rates, and that's a big deal for markets. Here's the connection. When inflation's too high, the Fed raises rates to cool things down. Higher rates mean borrowing costs more and slows down spending and investing. But at 2.4%, inflation's under control, so the Fed might start thinking about cutting rates instead. Lower rates are like a green light for stocks. Companies can borrow cheap, consumers spend more, and the economy gets a little boost. Now, I'm not saying rate cuts are happening tomorrow. The Fed's meeting next week, June 17th to 18th, is going to be huge. So we'll be watching every word they say, and if they hint at cuts, markets could take off. But if they stay cautious, we might see some disappointment. Either way, this 2.4% CPI number opens the door for a number of good things ahead. Next up, the jobs report. The U.S. added 150,000 jobs last month, which was a little below the 175,000 analysts were hoping for. Still, the unemployment rate held steady at 3.5%, which is near its lowest in decades. That tells me the labor market is still solid, even if it's not growing as fast as it once was. Now, get this, 150,000 jobs isn't a blockbuster, but it's steady. And that 3.5% unemployment rate, that's a sign that people are still working, earning, and spending. Consumer spending is the engine of the US economy, about 70% of GDP, so as long as jobs hold up, we've got a decent foundation. But here's the flip side. 150,000 is a slowdown from earlier this year when we were seeing 200,000 plus jobs a month. It's not a red flag yet, but it's something to watch. If hiring continues to keep cooling, it could signal the economy is losing steam. For now, I'd say it's a soft landing, not a crash. So, what's the takeaway? Inflation's at 2.4%, and a steady job market suggests the US economy is in a decent spot. It's not roaring like it was a few years ago, but it's not tanking either. For investors, that's a green light to stay engaged. Stocks tend to do well when the economy's stable, but for everyday folks, it's a reminder that prices are creeping up. That $5 coffee might be $5.50 by next year, so plan accordingly. All right, so let's get to the fun part, markets. Last week was a mixed bag. There were some clear winners and losers. The S&P 500 ended the week up 0.5%, which isn't massive, but still a win. The Dow Jones, though, slipped 0.2%, while the Nasdaq, that bad boy, surged by 1.2%, driven by tech stocks that just wouldn't quit. Here's the week in a nutshell. S&P 500 up, Dow down, Nasdaq flying, and that trade framework I mentioned, it gave markets a mid-week jolt. But other forces like oil, prices, and earnings kept things choppy. Now, let's talk tech because that's where all the action was. The Nasdaq's 1.2% gain was fueled by stocks like Tesla and Nvidia. Tesla jumped by 5% after announcing a new partnership with a Chinese battery manufacturer, making perfect timing with that trade deal, right? And Nvidia climbed 4% after dropping earnings that blew past expectations. Tech as a sector is up 2.5% for the week, and that's no surprise why. If you think about it, lower tariffs and rare earth access from China are gold for tech companies. They rely on global supply chains, and any easing of trade tensions is removing a roadblock. Plus, investor sentiment has been strong for tech all year. AI, electric vehicles, you name it. If you've got tech in your portfolio, last week probably felt pretty good. But not every sector is partying. Energy stocks tanked by 1.5%, and the culprit, oil prices. Crude dropped after the U.S. said it's releasing some of its strategic petroleum reserves to target and tame gas prices. That's a political move. Nobody likes $5 at a gallon at the pump, but it spooked energy investors. And if you think about it, oil prices fell about 3% after that announcement. Companies like Exxon and Chevron felt the heat, and the energy sector lagged behind. It's a reminder that markets aren't just about trade deals. Government decisions can shake up things too. A few other standouts. Financials held steady at 0.3% up for the week, thanks to hopes of rate cuts boosting lending. Retail stocks are flat. Consumers are spending but aren't going wild. And healthcare down 0.8%, partly because of uncertainty around drug pricing debates in Congress. It's a mixed picture, but that's what makes the market so fascinating. So we've covered the wins, trade progress, solid data, and tech rallying, but let's talk about some risks because they're still out there. First, that trade framework isn't locked in. If it falls apart, markets could reverse fast. Second, the Middle East. Israel's strike on Iran last week sent oil prices spiking briefly before the U.S. Reserve news calmed things down. And if that conflict heats up, energy costs could climb and that ripple about everywhere. Then there's the Fed. Their meeting next week is going to be a wild card. A hint at rate cuts could spark a rally, a hard no could trigger a sell off, and don't sleep on global growth. Europe's slowing, and China's recovery isn't guaranteed. It's a lot to juggle. So, my take short term, expect volatility. Markets are digesting all this, and any hiccups could shake things up. But if the trade deal holds and the economy stays steady, we could see a stronger half of the year in 2025. I'd keep an eye on tech. It's got momentum and energy, and because oil is unpredictable right now. So that's the week in a nutshell, folks. The trade breakthrough, stable economy, and markets doing their thing. It's a reminder that investing's like sailing. You've got to navigate the storms and the calm. So stay informed, stay diversified. You'll weather it all. And how about you? How's this trade deal hitting your portfolio? Drop a comment. I read them all, and hit that subscribe button if you want more breakdowns like this. Until next time, have a great rest of your day.